Good morning, everyone. Welcome to another edition of Cooperative Network's webinar series. I'm Daniel Smith, President and CEO of Cooperative Network. Today, we will be discussing challenges and changes in the insurance industry. As a homeowner, a farmer, a business leader, I'm sure you've noticed these changes, which have been very impactful and have been covered by the national press coast to coast. So it isn't something that we're just dealing with here in Wisconsin or regionally. We're seeing it across the United States. So what is happening and why? We've assembled a panel of insurance experts to help us understand. Our panel will be moderated by Patrick Laws, President of the Wisconsin Association of Mutual Insurance Companies. Pat, I'll turn it over to you and allow you to introduce your panel and begin our discussion. Thank you.
Thanks, Dan. So I'll just briefly introduce the panel since we only have an hour. So we've got Tony Wilkie is with United Mutual, which is a division of Ohio Mutual. Mike Canfield is with Grinnell Mutual reinsurance company. Todd Lentz is with the Mutual of Wausau out of the Wausau area. Ben Lampman is with Gallagher Re, and Doug Madrell is with Guy Carpenter, and Gallagher Re and Guy Carpenter both reinsurers as is Grinnell. So thank you, gentlemen, for joining us today and talking about our industry. So I think it'd be a good idea to start out talking a little bit about the current state of the industry. And so I'll throw that up to, Mike, do you want to talk about current state of the insurance industry, in particular in the Midwest and Wisconsin?
Yeah, absolutely. I think it can be simplified down to there's been a lot of losses that have been paid in the last, you can say 4 years, starting in 2020, that ratio in 2020. Now, it didn't hit everybody, especially Wisconsin didn't hit as bad, but in other states, that kind of started a little bit of a snowball effect with some inflation, some losses. The easiest way to think about it right now is that the insurance companies have a lot of dollars going out the door, but not enough dollars coming in on that front end to support it. It's what we call in the insurance industry a hard market. It's when there's been substantial losses over years, not enough rate, not enough premium dollars coming on the front end. And then to simplify the whole thing down, the way I always kind of think about it is insurance companies are going to find a way to make money over time. Whether it's going to be restricting coverages, whether it's going to be increasing rates, or both at the same time. They're not going to continually to post losses, if that makes any sense. In the last 4 years, most companies in the Midwest have posted some substantial losses. Does that kind of cover where we're at, why we're at it? You can attribute it to inflation, or you could attribute it to losses because of weather. But for the majority of it, it's just dollars coming in are not equating to dollars going out. There's a lot more dollars going out right now than there's dollars coming in. So
great, thanks, Mike. Doug, I'm going to throw it over to you next. Could you talk a little bit about what's going on nationally and how what happens in Florida and California, for example, affects our insurance rates and reinsurance in the Midwest?
Sure. The insurance market as a whole is a global market, and what happens, on the coast actually impacts us in the Midwest. So, and we don't always realize that, but because of the market, and the reinsurance market, the insurance market combined, it's the spread of large numbers is what insurance is all about, spreading that risk out. So, we're seeing impacts from even other countries. Those losses are impacting rates all across the world. So your rates aren't just from what happens in your local areas. So there's a lot of things that are impacting that now. And inflation, I want to add to Mike's thing. Inflation is a really big thing that's kicked the insurance companies over the last 4 years, in particular, just the pricing of everything. And that's a big part of why there wasn't enough dollars collected for the losses that were paid out, because of the inflation was a major factor in that.
Great, thanks, Doug. Ben, you want to address, we talked a lot, and Doug mentioned that, insurance is a global industry. Talk about what's going on in other parts of the world and how that's affecting the insurance markets here in the U.S.?
Yeah, absolutely. So, it's a really, really interesting thing. We had such a long period of really low interest rates, really low inflation, and we're, 15 years or so of that environment. And, the last 4 or 5 years, around the world have really caused this triple whammy of, like everybody has said, inflation, add on top of that the increase in interest rates, which has restricted capital at the highest levels. And then at the same time, um, you know, we have all of these storms coming through, specifically in the Midwest, but also worldwide. You had things like uh, floods in Europe that are not typical. We've had large losses in the Asian continent. And so, at the highest level, where all the capital and the funds are coming from that filters down to these individual insurance companies, it's really being hit by this triple whammy where we can't increase rates fast enough. We can't, um, really compete with, what's going on with the inflation and things like that. So it's really just a very unique market. It's something I've never seen. So it's all those different factors are creating more competition, creating more issues on the pricing side, and a lot of companies are struggling to keep up with those.
Great, thanks, Ben. Todd, can you talk about we've talked about reinsurance. Maybe we should explain the difference between insurance and reinsurance.
Thanks, Pat. Hi, I'm Todd Lenson, President and CEO over at Mutual of Wausau in Wausau, Wisconsin. Been in the industry for about 30 years now. Spent some time in reinsurance as well as insurance. And for those of you maybe not familiar with those two terminologies, reinsurance is essentially where insurance companies go out and buy protection. So as a consumer comes to us to provide protection for their home or the farm, we have a lot of policyholders. We're relatively small. As an example, Mutual of Wausau has about 25,000 policyholders. Okay. Ultimately, we cannot handle all of that exposure ourselves. So we go out to folks like Mike and Ben and Doug and others in the industry to either get reinsurance from them or from whom they can purchase it from on our behalf. So it's a way to share in the losses, get other companies involved, where we have a deductible similar to you and I as a consumer have a deductible on our policy. It's just referred to as a retention. Only those numbers are quite significant. And those numbers, as far as our deductible, our retention, have gone up significantly in the last couple of years as a result of not only losses in the U.S., but as the previous panelists have mentioned, the global losses that we're seeing.
Great, thanks, Todd. Tony, can you talk about, insurance companies look at claims in terms of severity and frequency. Can you talk about storm severity and frequency and what impact that's having on insurers right now?
Right. So if you go back decades, you can see trends where the frequency of the storms are increasing, but also the severity of the storms are increasing. And that's two fronts. The storms are stronger, they're bigger, but the values of the property being insured are also much larger. So as that's coming through, and then you have the double whammy of COVID and inflationary issues coming out of that, your average loss somewhere pre-COVID, we had a hail event that the average cost per that claim was $10,000, and now they're running somewhere between 25 and 30,000 for a similar claim, and we're only talking 3-4 years later. So it's a frequency issue, it's a severity. I think I read a few weeks ago something about hail is larger now because of the warmer temperatures, and they stick together to make a much larger hailstone. So good news there, right? So it's just a whole lot of things happening at once. It's kind of like this perfect storm all coming together. More frequency, larger values, and less capacity on the other side to come back down and provide the protections that were available 10 years ago.
Thanks, Tony. So we've seen a lot of consolidation in the industry in the last couple of years. In fact, in the last 2 years, we've seen 36 mergers of insurance companies in Wisconsin at the Farm Mutual level. I'm going to throw this over to Todd. Can you talk about what that consolidation means for the broader industry and for consumers?
Sure, Patrick. As Pat just mentioned, there's been a lot of mergers. It isn't something that is new to the industry. In the world that we work in the rural sectors, the companies out there are very similar to co-ops. They have a long history. Companies are approaching 150 years old this decade. But at one time, Wisconsin had over 120, 130 of those type of entities. And over the years and decades, neighbors have come together and merged. And this company that I'm representing today is about 15, now 20 companies that are really looked at as part of the heritage. So that contraction has continued year over year, maybe one or two a year. But as Pat pointed out, last year and the year before, it's accelerated to over 30 mergers taking place. So what happens in conjunction with the hard market that Mike referred to in the beginning, as those companies are being merged together, the companies that are surviving are oftentimes really in a stabilization mode. They're not in a growth pattern because they've got all the growth that they can handle by rolling this business into their respective companies. So that takes some players out of the open marketplace willing to write a lot of business. And that's, I think, how we find ourselves in, as we just had a number of mergers coming in. We're not actively looking, our doors aren't closed, but the desire to go out and grow policy count just isn't there because we don't have the capacity to do it, for the personnel to write that business. So you compound that with 30 other companies, it starts having a drain on the availability of insurance, because a lot of carriers either are reeling because of the merger or simply because of the costs that we've been talking about here recently. Reinsurance, as we opened up with, has came to the industry and increased rates significantly in a short period of time. That has also contracted the ability for companies not only like us, but the larger regional carriers as well are not in an active growth pattern. So it makes the availability of insurance more difficult right now.
Great, thanks, Todd. Talk about impact to insurance companies. There's been part of the consolidation is some companies are actually contracting their writing territory and moving out of certain states. Doug, could you maybe address what we're seeing as far as that goes? How companies are kind of pulling in writing territory and competition's decreasing?
Yeah, definitely, Pat. Especially in the Midwest, we're seeing a lot of companies pull out of the Midwest that in the past there used to be kind of a protected zone for the reinsurers in particular. They would, the coastal areas were beating them up in the U.S. a lot of times with hurricanes and such. And the Midwest was kind of a place that was fairly safe for them to write business and to offset some of those losses that they were getting on the coastal regions. But now I think you're hearing stuff in California, Florida, where companies are pulling out, not willing to offer coverage to homeowners there. We're seeing this in the Midwest now, where we're seeing a lot of major companies not wanting to write in the Midwest. And we're even seeing it on the reinsurance market right now. The reinsurance market as a whole is somewhat softening. It's still a hard market, but it's somewhat softening, but not in the Midwest. The Midwest storms, the convective storms have really frightened the reinsurers just because of the severity that they're getting with these storms and the claims that are coming through. So we are seeing that. Will that continue? I guess for a little bit. It's a lot tougher when we don't have the markets to go to. When you don't have the retailer to go buy the product from, where do we get that product from? So it is a little bit of a challenge, in some states in particular. I live in Iowa. Iowa is one of the states right now that is on reinsurers' radar, just because of the recent storms we've had. And, the derecho came through here and it's just kind of beat us up in the Midwest. And it kind of has everybody running from that area. So it is a challenge we're dealing with as the industry, is to have providers available for our insureds.
Thanks, Doug. So I note that I did a little prep for this and looked it up, and there's currently about 65 farm insurers or ag insurers that operate in Wisconsin versus over 235 homeowners insurers in the state. So quite a bit less competition in the farm market. And of those 65, there's probably a dozen that are farm insurers because they're writing a few hobby farms here and there and don't have a big book of farm business. So the actual number insuring actual farms is a bit lower. Can you talk, Mike? Can you talk? You're Grinnell's based in Iowa. You're right in the heart of farm country in the Midwest, and Midwest is the breadbasket of the nation, so to speak. Can you talk a little bit about the impact it's having on ag and the farm economy, and the impact on farm mutual insurers?
Yeah, absolutely, Pat. I think back to your point, there's not as many people writing farms in this industry anymore, and everyone knows you can't make new farms, so there's less farms to go around. To write a farm is a much more specialty skill base that not everyone has. I think I'm younger than everyone on this panel. I don't have the skills in place to write a farm. I didn't grow up on a farm. Never did that. You're starting to see that with some of these younger generations just not having the knowledge and the base to write farms. So where does that go as the older generations are starting to phase out of this industry that grew up on farms, especially in these farming communities? If you can't find a good replacement to backfill those farms, well, homes are a little bit more comfortable of a risk to write at the moment. Not saying they're a good risk at the moment, but you understand them a little bit more. Most people are homeowners. Not everyone's a farmer. So kind of with that in the Midwest, what you're seeing is the consolidation of farms, of course, and then you're seeing less people writing them. Well, these farms aren't just your small farms anymore either. You're starting to get a lot larger risks at these farms that some of these mutuals aren't always comfortable with. There's some insurance companies that write farms aren't always comfortable with these large, almost commercial risks, you could call them, in that farm sector. So to that point, you're just seeing a lot less supply and a lot less confidence in how to write them and doing them properly. And then you compound that again. I know we're kind of beating a dead horse here, but you compound that again with these losses that happening. Kind of back to what's happening in the Midwest. It used to always be, if you think about the Midwest as a sheet of paper, if a tornado came through, it's basically like you took a piece of a pen, and you just drew a line, and that's where your affected area was. It's a pretty small concentration. It was probably pretty bad in that concentrated area, but it was just a pen mark. Now you're starting to see 2020 is a prime example. 2021 had another one. You're seeing these widespread derechos where I have a toddler downstairs and at the house here, it's summer break for the family. Basically, if you give her a highlighter and you just start coloring that sheet of paper, that's kind of the affected risk now, and that turns into a lot more farm buildings, that turns into a lot more metal, that turns into a lot more potential loss, The same thing with hail. You know, hail's not as concentrated as a tornado. Tornado, it used to be the risk in the Midwest, and now it's starting to be widespread hail. Well, when widespread hail goes through 3 Morton buildings, that's an expensive bill on that back end of things. And when that starts happening, you're starting to see these back to this whole situation we're in where there's more dollars going out than dollars coming in. And that is just causing the condensation of mutuals, back to where Todd kind of referenced that they don't have the capacity to write a $10 million farm anymore. You know, they might be able to write that hobby farmer that has one outbuilding, but do they have enough to insure 360 by 120 buildings with 4 or 5 $600,000 combines inside? Probably not. You know, there's just not enough appetite for that anymore, if that makes any sense. Did that kind of hit your point there, Pat, or what you were trying to get to?
Yeah, actually it did. Thanks, Mike. So we've already talked about claims severity and how, you know, we talked about how hail is getting much bigger and storms are causing more damage when they hit than they have in the past. And then you tack onto that inflation. So in, you know, 2023, we saw construction material inflation of, you know, 15% and construction labor inflation of 20% for a cumulative of 35% construction inflation. And that's all cumulative, so that 35% doesn't go away. It gets built on as inflation continues. Ben, can you talk a little bit about the impact that's having on pricing for consumers, and you know, what consumers can begin to expect that and some are already seeing on their renewals?
Yeah, sure. So, I mean, you know, going back kind of to the last question too, you know, the market's really driven by competition. And as you've seen, you know, different carriers not or exiting markets, or different insurers not writing different lines of coverage. You know, some are pulling out of personal lines and not writing homes or not writing farms. You know, they may be going into more lucrative areas of, you know, some of the commercial areas, just because the economics really aren't there right now. So, you know, personally, what I'm seeing is, you know, on my own home insurance, it's almost doubled in the last 2 or 3 years. You know, and it's not just a Midwest thing. I'm hearing it all across the country, but particularly in the Midwest. And just a couple weeks ago, was listening to a podcast, actually, The Daily, and it was an insurance podcast on my hometown, Marshalltown, Iowa, and just talked about kind of the state of insurance right now. That town had gone through one of those derechos, was also hit by a tornado. So in the past 5 years, I think there's been 2 tornadoes and at least 1 derecho, if not 2. And so, you know, that podcast went through and interviewed a lot of local people, a lot of agents and insurance salesmen in town. And there's just not the options that there used to be. There's a lot of people that are potentially having to go without insurance, or, you know, find ways to maybe go to a secondary market that's not as protected, or come up with some, you know, unique solutions like increasing their deductible significantly, where, you know, you might have had a $500 deductible, but now you have a percentage deductible. Maybe that's a 1 to 5% deductible. So you're talking about retaining a significantly higher portion of a loss. So say you had a hailstorm, instead of, you know, only paying a $500 deductible, you might now be paying, you know, $10,000 before that roof would be fully replaced. So it's, you know, all around, it's just, you know, like I said earlier, it's such an interesting market right now. And, you know, with the price increases and things going on, it's difficult all around for everybody.
All right, thanks, Ben. Doug, Ben mentioned affordability and it kind of touched on availability. Are you familiar with what's going on in California, Florida, and Louisiana with availability? And can you talk a little bit about, you know, what they're going through out there compared to here? And can we expect that to become an issue in the Midwest?
Thanks, Pat. I hope not. You know, those states are having a little bit of challenges right now with the availability. It's really difficult to live in California and Florida right now and to get homeowners insurance. I have a coworker that moved from upstate New York. He decided to move to Florida, and he and his wife went down there to basically retire. And they bought a house. They're probably 20 miles inland. And the smallest deductible he could get on his house, if he wanted coverage, was $25,000 for wind and hail, hurricane type coverages. So we are seeing this happen. If we're going to, if the providers are going to have the coverage available to us, they're going to change the way they write the coverage, and they're going to put more burden on the insured. You're going to have a higher deductible. So in those 3 states in particular, I don't work in any of those states, but I do know that the carriers that are in those states are having a very difficult time getting reinsurance coverage, and getting the placement of their programs. And that's creating some of the challenges. And that's a lot of the reason why they're moving out of states, is because of the reinsurance market and the way that that's dictating to them where they should write and where their exposure should be. It's all about exposure modeling. And so, those are things that they're looking at very closely right now.
Great, thanks, Doug. And you touched on deductibles. Tony, could you talk a little bit about what consumers can expect to see in the Midwest, and particularly in Wisconsin, and farmers in particular, with regard to deductibles?
All right. Yeah, it's a big topic. And some of this is coming from the reinsurance side of things. Maybe we didn't do a good job here of explaining, all premiums kind of funnel up each step to the higher reinsurance and the larger reinsurance companies that are global. The losses do the same thing, both on a storm basis and a per risk fire type basis. So some of this is kind of dictated from the top. Hey, what are you doing on your base level policies? Are you offering a percentage deductible or a higher wind hail? I think it's common now to see a $2,500 minimum wind hail deductible for a policyholder. I think you're going to see more and more the 1, 2, probably 3% deductibles are going to be more common. It's to try to maintain some sort of affordability. You have to maybe take on more risk as a policyholder. Deductibles is one way. Maybe, actual cash value on your roofs and stuff is another option. The companies may force that on you. I think that's a more and more common item that's happening in today's environment. So expect higher deductibles with lower premium breaks, at least for the foreseeable future, as this hard market continues.
Thanks, Tony. Todd, it seems like, well, ever since I've been in the industry, which is well over 25 years now, policyholders always viewed, or the perspective that I think a lot of them bring to the table with respect to insurance is, I paid for this, and I at some point should get something out of it. I pay all these premiums and I've never made a claim, and then they expect something back at some point. But that attitude is really going to have to change in the current market going forward. Talk about what the policyholder wants out of their insurance versus what they need. Can you kind of address what mindset a policyholder should have with respect to what their insurance is, what they're paying for, and what their expectations should be for that?
I was hoping I'd get that question, Pat. So we have obviously some of these questions in the jar for today, but all kidding aside, it's a tough question. I think it really has to start with educating the consumer what is insurance and what isn't insurance. All of us probably on this panel went to school for something else, and we ended up in insurance. It's a common theme when you talk to insurance professionals. Per se, there really isn't a degree in insurance. It's a potpourri of knowledge that you obtain. Now, take it to the consumer level. Coming out of high school, what I knew about insurance, and even out of college, was my parents told me, you should buy it, you need it, you want to have it. What does it do for you? Well, it protects you. That's the level of education, that I'm dating myself 30 years ago. I think that's improving, but to the extent that there is still the expectation that if there's damage to my property, or if I damage something else of somebody else's property or to them, I'm covered because I have insurance. And the real answer to that is maybe. And that's where the education is critical, especially if you're a business owner. You know, I use the analogy, I guess, in we'll use farming. I think you have an understanding of what do you need in that seed, what's the maturation period, you know, what's like a time for the growing season. There's probably a lot more to it to know exactly how I'm going to get the best crop out of it. And I think buying insurance or any of your other partners, you really have to have an understanding of what you are getting. We strongly still believe in agents. We haven't talked too much about agents. I think most of us as consumers, when we think about insurance, our first call is to our agent, not necessarily even to the company. So some folks even think their insurance is provided by that agent, period. But that agent ends up being our main focal point of really educating the consumer. Oftentimes, some of that education is painful because it comes out at the time of a loss. So back to Pat's overreaching question on insurance, the need and the want and the availability, affordability, it goes back to an opening statement. I think Mike made it about law of large numbers. That's how we are able to price insurance. As bad as you've heard it today, for example, Wisconsin is still only the 43rd most expensive state in the union to buy homeowner insurance, as an example, even after a lot of recent rate taking. So I would more like to stress, I guess, with the end consumer is really understand what you are buying. And I think that will go a long way in, are you getting what you want and need? So it was a tough question when I saw the list of questions for today's meeting, because that is that oftentimes comes out at the claim is like they don't, your policyholder or you and I as consumers may not understand why this isn't covered 100%. An example that we all, at least as from a carrier standpoint, just went through because of inflation is, if you haven't looked at your own home lately, you should. You know, a typical house that maybe was had value of 200,000 to replace it as little as 3 years ago is probably going to cost you over 325,000, 350,000 to replace that. So if your coverages aren't keeping up with that and you have that total loss, that difference is coming out of you and yours and my pocket as the consumer, not the insurance company for that shortage. So that is also what's been churning the marketplace. So every time you raise coverage, we raise premium. So for that additional protection that you're buying. So it's a double-edged sword, and everything that is going on, because we're raising coverage because we need to, because the losses are higher, but the premium that we're getting because of the frequency and severity of losses, we're also increasing our rates at the same time. So we're asking a lot of us as consumers.
Thanks, Dad. Tony, did you have any thoughts on that question?
Well, I know, Pat, you and I have talked about this in the past, educating the consumer of what is insurance and its intent. And I think the industry kind of did themselves some disfavors over the years, over the decades, really, of just making it more of too much of a maintenance policy instead of a catastrophic what insurance is meant to be. You know, you have a fire, let's get it you built back. Tornado comes through, let's cover the people that were impacted. And I think there's been a few decades of you know, now we're covering these bells and whistles, the full replacement cost, where you know you get 20 years out of a roof that's only have a 25-year life expectancy, and you're getting full replacement costs. I think those days are probably over, at least for the time being. You get 20 years out of a roof and you have damage, you're going to probably get hit with some depreciation on that, which that's the part that maybe the baseline consumer doesn't really understand. And Todd mentioned it there a little bit. And it goes back to the wants versus needs. Do you need replacement cost? Probably not. Do you want it? Probably. What's the pricing going to be on it, right? Or does your property even qualify? I mean, that's another underlying toll here is not everybody's properties. They're all different, right? Unique. Everything has, you know, even you put two roofs on two different buildings at the same time across the street from each other, they don't wear the same way, right? There's differences everything we do. So that's what I would say is it, you know, from an industry standpoint, educating, you know, what is insurance intended for, and especially in the property space would really help, I think, mitigate what's going on in our marketplace right now.
Yeah, so you talk about then you kind of touched on replacement cost versus actual cash value. Could you explain the difference between ACV, actual cash value, and replacement cost? And you know, at one time, all insurance was actual cash value, and at some point, we added replacement costs as an option. But I think people now more see it as just a integral component of insurance. And talk about the difference and how that works out in a claim scenario.
Right. So the concept is, you know, let's just use a 25-year roof. If you put a shingle roof on and its life expectancy is 25 years, if you want to simplify things, technically, like you lose 4% of that value every year until 25 years, you should replace it. If you get, say, 20 years out of that roof and it's a 25-year expected roof, straight line depreciation would say, okay, you've gotten 80% of the life out of that. We're going to depreciate it 80%. Now, every company does depreciation a little different. The simpler way of looking at it is when you have a damaged roof, you have a $30,000 estimate. The company will come through and say, okay, here's what it costs to replace your roof. Here's what we think is a fair amount of depreciation to take off of that value, and then give you what we call the actual cash value settlement of that. So there's a lot of factors that go into that. It's condition of roof, age of roof, the material used. Metal roofs are going to wear differently than a shingle roof. There's new, you know, the shingles are composite. There's all kinds of things out there now. So there's a lot of factors that go into it, but really it's no different than you buy a car. If you drive that car for 10 years and you total it, do you expect to get a brand new car? You shouldn't, but that's the similar concept is you're going to get paid what that car was worth at the time of the loss.
Thanks, Tony. Ben, not all these changes are coming just solely because carriers are changing their operations. There's a lot of pressure from the reinsurance market. Can you talk about how the broader reinsurance markets are pushing insurers to make operational changes?
Yeah, absolutely. So you see this in a number of different areas. You know, with reinsurers ultimately being responsible for a lot of these large losses, they do have a lot of power to, you know, push some changes, and specifically things on coverage, but not always just coverage, you know, just general operations of insurance. You know, they want to make sure that the companies that they're reinsuring are financially stable and are, you know, operating in a way that they want to affiliate themselves with. So, you know, a lot of different things that we've seen specifically kind of on like the coverage side in the last number of years is a lot of exclusions on new and emerging types of risks. So, you know, after the 2020s, early 2020s, you know, we saw a lot of restrictions on communicable diseases, whether that was from like, you know, a commercial business perspective, so that somebody couldn't sue the business for, you know, getting sick at work, or, you know, also on like farm and ag properties, where, you know, we're seeing a lot of, you know, like swine flu and different things like that. So, you know, a lot of those risks are sometimes just viewed as uninsurable. There's just not a good way to raise enough money to pay for the nature of that type of loss. You know, other things that we're seeing are these ACV pushes from reinsurers to require ACV on roofs or other things like that. You know, really trying to lower the costs of these claims, and get back to a position of profitability for the overall market. You know, other things that we're seeing are, you know, just general claims practices and things like that, that the reinsurers want to make sure that, you know, the frontline insurance company is following, whether it's, you know, how they handle, you know, notifications of claims and all these different things that happen in the claim process. So yeah, it's a constantly evolving and changing world. And, you know, in a market like this, like Mike said, it's a hard market. What that really allows the reinsurers to do is have a little bit more power in, you know, making these changes and, you know, saying, hey, we want you to change how you're operating this way or that way, because, you know, we're struggling to find money on the top end of things. So, yeah, it's like I said, it's constantly changing market, and which makes it extremely interesting to be in. So,
Pat,
Yeah, Doug.
could I just add to both what Ben and Mike said? I'm actually working on a presentation to compare ACV versus replacement cost. And as I said earlier, I'm based in Iowa right now, and we've got a lot of insurance companies in Iowa that are going ACV. If you have replacement cost on your home, you go AC. They're providing ACV coverage for all exterior, so they'll give you actual cash value on your exterior. And the reason for that is everything on our exterior of our homes has a limited lifespan, so it's meant to wear out at some point, and that brings back maintenance and everything like that to the consumer. But we did a test. We had a company, a claims company I'm working with right now. They're doing a comparison for a company that had the tornado hit here in Iowa. And we were talking about severity of these storms. This tornado that went through Iowa recently stayed on the ground for 44 miles straight. It was a half-mile wide. That's just crazy. You know, usually they pop up and down, and you know they drop every once in a while, and they take something out and then they go back up. But for whatever reason, this one stayed on the ground for 40 miles. So I'll just give you some numbers here quick. So they did average wind claims for me, and they did average hail claims for me. So in 2023, an average wind claim was running an insurance company around $15,000. Okay, this was with replacement cost. So then the companies this year implemented the actual cash value on exterior. So we wanted to see how big of an impact would that make on the insurance company and the consumer, because obviously the difference is the consumer is going to be responsible for the difference in those dollars. So a 24 average wind claim is costing $10,250. So by going ACV, it's saving that insurance company about $5,000 per claim, which is actually more because you add inflation to that. It is a bigger number than that. They did the same thing with hail claims. In 23, the average hail claim in Iowa was 17,000, and in 24, we're running 12,000. So again, there's a significant difference there, and again, inflation's involved, so it is a larger number than what those numbers are showing actually. So I just wanted to kind of point out the difference between ACV and the replacement cost and what we're seeing, how that's impacting the insurance companies.
Yeah, thanks on that. Doug, can you also touch base, Doug, on since I got you up here, what's the future look like? I mean, how long can we expect these pressures to continue, or can we expect some sort of level off at some point here in the near future?
I'm looking for a crystal ball. You know, a lot of it's going to depend on weather, in my opinion. You talk to the reinsurers right now. Again, the Midwest is kind of a hot spot. They're not comfortable with what's happening, the convective storms, the derechos we've had. They've created losses that we could never fathom. We model everything. That's, you know, reinsurers, insurance companies, we model our exposure, see where everything is at, and they try to come up with a probable maximum loss that it could be. And our models were not even remotely close for these derecho losses we've encountered here in the Midwest. The tornadoes, they're blowing our models out of the water. So we all know the models aren't correct, but they're a gauge that we can use to kind of determine what it could potentially be. Pat, I think if, you know, what the future is going to hold for us, we're going to see changes in how the insurance companies write our business. That's given. I'm with American Family. At 5 years, they're going ACV on my roof. Once my roof's 5 years old. So, you know, they're changing. All the big companies are changing this too. We need a break from Mother Nature. We really do in the Midwest, because right now the reinsurers are not comfortable with the Midwest. They want to limit their exposure here, which is creating a challenge for Ben, Mike, and myself as reinsurers to get placement for guys like Tony and Todd. It's tougher because that market is not as willing to invest in this area right now with our experience we've been having. So I know I didn't answer your question, Pat. I don't know. I'm guessing in, you know, if we can have a decent, this year's kind of halfway done, and we've been toasted in this state already, and we've had some of the Midwest get popped. But I truly think if we can have a whatever average is for a year or two here, it will settle down again. But maybe Ben and Mike have some more to add to that. I just don't. I don't see it opening up a great deal in the Midwest, unfortunately.
Yeah, and I can jump in on that too. You know, it does. We have been a little bit doom and gloom here with some of the forecasts and things, but you know, I do think we are starting to kind of reach that inflection point a little bit. So there is a little bit of, you know, sun on the horizon, where we are seeing, you know, inflation hasn't been as rampant as, you know, the past few years. So, you know, we're still seeing larger than typical inflation, but it's starting to slow down. You know, we're starting to see some of the large reinsurers come back to profitability, you know, whereas they maybe the last 5 years have really seen record losses. You know, they're starting to get a better grasp of, you know, some of these changing environments, you know, as far as claims and inflation. So, you know, we're starting to reach that point where there is more competition on the global scale, which pushes down to the local scale. And, you know, we are starting to see some positive things happen. It's just kind of a matter of time. And like Doug said, you know, we really could use a break from some of the weather, specifically in the Midwest. You know, one of the things we've really seen also, though, is there's been predictions for a record year on hurricanes in you know, the southern United States and on the coast. So, you know, some of that has yet to play out, and we'll see really what happens. But you know, it's all a cycle, and so once profitability returns, once there's more capital in the marketplace, lower inflation, we should start to see things return to normal, as you see more competition come in. So I think ultimately that's really what happens is, you know, we need to see more competition to really drive down rates again, drive better terms for local insureds, you know, so we're not having some of these ACV restrictions and different things going on. But, you know, I do see some light kind of at the end of the tunnel, but it's just how far off is that?
Yeah, and I'll piggyback on the last piece of it being to reinsure the Midwest, just like Ben and Doug. And actually Ben, Doug, and I all live in Iowa, so we're all the most affected by all of this. So Ben nailed it on the head there. I think the only way to tell when this whole industry, you could say, would right itself or maybe calm down a little bit would be just to see profitability again. Insurance companies are businesses. You know, if you run a loss for 3 years in a row, you're going to do whatever you can to prevent that loss from happening. You know, if you're in the red for 3 years in a row, you can do whatever you can. And you're probably not going to take your foot off the gas until you start seeing some black on that balance sheet. So with that, it's of course back to the weather. We need to prevent the weather and all this other thing, but back to the deductible shifts, these rate increases that all these companies have been taking. They're doing a lot of those things to try and improve that profitability on the back end of the whole thing so that you post a year or two of profit, you know, you might start looking at how can we get back more competitive in this industry. But right away, companies, insurance companies especially, the competitiveness and worrying about what others are doing has kind of gone out the door. You're kind of worried about making your own shit right and getting dollars back in the door. You know, if we lose business because we can't make money on it, you know, because a competitor at a better rate, insurance companies at this point are saying that's fine. You know, we probably would have lost money on it at this point anyway. So we're okay letting business go out the door because we are losing money. So we need to figure out a way to get our current books correct, make money, and then we can maybe take some of these pressures off. But until that happens, that's why when Doug says look for the crystal ball, we always kind of make that joke in this industry. We'd all be billionaires if we all had a crystal ball and could predict some of those things. But until the results start coming through profitable for a lot of companies, you're just not going to see much relief, truthfully, you know, because why would you get relief while you're losing money? You know, you got to get those balance sheets back making money again before you can start providing some relief back. And I think that's now, is that this year? Who knows with what the weather does? Is that next year? Who knows what the weather does? If the year after that, again, who knows? We're kind of back to what Ben said too. We're kind of at that tipping point. I think a lot of companies have done a lot of drastic things over the last 3 years. They're all kind of maybe holding their breath and hoping they've done enough. But if this year turns into a bad year again, they're going to continue to keep doing more actions, in my opinion. I think everyone's done some really drastic things lately with rates and coverages and deductibles, and hope they did enough. But if they didn't do enough, they're going to continue to keep making moves and keep those pressures on until they start seeing some profitability on the back end of all this. So until the industry as a whole, and that's not just talking just Wisconsin, that's talking Iowa, that's talking Minnesota, Illinois, Florida, California, because back to the whole reinsurance thing, how it all funnels up, money has to start coming back in, and then we'll start feeling some pressures come off. You know, they need to start posting some profits year over year. So that was just my take on it, kind of what I've seen in the industry right now too. So
one more quick point. You know, I've always thought, you know, insurance is kind of really the grease of that makes the economy work. Where, you know, if you're a local farmer, you're not going to go out and invest in building new buildings if you can't protect that. Businesses are not going to invest in, you know, new inventory and things like that if there's too much of a risk of losing it. So, you know, in this environment where there's been so much change recently and there's been a lot of unhappy consumers and there's been, you know, a lot of struggles, you know, what we've seen historically is there's innovation that drives new companies. And you're seeing that with new startup like insurance technology focused companies that are, you know, bringing some new exciting things to insurance, you know, trying to capitalize on AI and all of those things going on there. So, you know, they're really recognizing, you know, the need for that thing. So did want to add that also, is that, you know, there is that kind of horizon of new things coming to the market continuously and innovations. And, you know, we're hoping some of that does drive and lower costs and provide more opportunities and options for insureds.
Great. Well, thank you. I did want to we had one question got sent in before the webinar that I wanted to get to, kind of insurance related, but not quite on the topic we talked about today, but I want to throw it out. So as a kind of a background to it, in April, the Department of Housing and Urban Development rate, they put a cap on the deductibles that can be applied to insurance policies for FHA with FHA mortgages, multifamily dwellings. So we're talking, and I assume that the question came in from a community housing co-op, and they raised that cap in April. And so the question we had, pull it up here. I just had it. Question is, we currently have a 2% wind hail deductible on our co-op master insurance policy. However, our members carry a $25,000 loss assessment coverage in their HO6 condo policies. And given that our total loss coverage or total loss assessment coverage exceeds $2 million, would you still recommend we request a wind and whale haver from HUD if our 2% wind hail deductible exceeds HUD's maximum deductible amount? And throw that out to our insurance professionals and see if you have a thought or an answer on that. Anybody?
I'm gonna go back to maybe answering that question. You need to talk to your agent. Your agent's going to be best equipped to guide you on that. It becomes a personal decision as you as a consumer, and what are you willing to put to risk. We're not as well versed, I guess, in the HUD requirements. If I'm speaking for the panel collectively here. So, but I would talk specifically, that was kind of going to be kind of a wrap up point, is use your agent. Their knowledge is probably going to be the broadest of anyone you're going to encounter when it comes to talking about insurance and what is the best protection for you or your business. So.
Yeah, then the follow-up question was, do you recommend that cooperative members provide annual proof of their HO6 policies?
Who are they providing it to? The government or HUD?
I think to the co-op that has the general homeowners association policy.
I guess my quick thought on this is we're as a company, we're going to do what's in our best interest. And if that doesn't necessarily fit particular policies, they might all have to migrate to a carrier that can accommodate their needs. Again, like Todd said, you got to use your agent appropriately in that. And if that's a necessary item that they have to do, I guess that I don't have any experience in it to really shed any light on that particular question.
Yeah, I'd say, again, check in with your agent on that, because, I do know they may have things like checklists or other things that, you can go through the line and say, okay, these are different things that we want to make sure we're requiring, whether that is proof of insurance on a yearly basis, whether that's, different loss control measures or different things like that. They may have some checklists. And if they don't, I'm sure some of the companies they represent would.
Yeah, I guess I would also say that on requiring the proof is, if you're running the association, and I come from the association side now as well, to me, I would want to, knowing what my deductible is on the association policy, knowing that members have $25,000 loss assessment coverage on their HO6. Yeah, I would want to be able to do the math and say, okay, I have this many people with HO6 policies that have up to 25 grand coverage, and is there enough there to cover the association deductible? And if not, do we have enough in reserve set aside to cover the shortfall? And if so, do we have enough set aside in reserves in case we find out that, they let the policy lapse after they provided proof? Because that happens sometimes as well. So to the question too, as an association exec, I would say, yeah, I would like to see that. Just for my peace of mind that it's there. It may not all be there when you actually have a claim, because again, people have tendency to do things they're not supposed to do, but at least you'll know most of it's there, and you'll have a contingency plan so you don't have a shortfall when an assessment has to occur and you find out, they don't actually have the money and they don't have the coverage that we thought they did. And so with that, I think we're through all of our questions and looks like through time. And I even got in the extra question. I don't know if there's any other questions that came in through the Q&A and chat, but I appreciate you gentlemen joining us for this and providing your insights. And I will turn it back over to Dan.
Thank you, everyone. That was an excellent, very in-depth conversation. I really appreciate all of your time and sharing your expertise and experience. We'll continue to look at this, and we'll continue to work very closely with Pat on these issues as the industry continues to change. So thank you so very much for sharing your time with us today. Cooperative Network is committed to providing education and training on issues vital to cooperatives. Our next webinar will be at 9 a.m. on July 25th, when we will discuss cooperative communication programs, best practices for communicating your cooperative story with your consumers and the general public. So thank you to our sponsors. Thank you to our panel. Thank you, Patrick, for all your work in putting this together. Until we see each other again, be well and thank you.
Thanks, Dan.